Morning. Thanks for joining us on our Broking Breakfast session on navigating the FCA Business Plan. As ever, with the FCA's Business Plan, there's quite a lot to digest. I certainly kept finding new relevant sections every time I reread it. My guidance to you is not to try and do it in one go. As ever, there's a great source of information to help you understand the direction of travel at the FCA. We've decided to select 3 key topics from the business plan for you, which we think are really relevant right now. My colleagues Paul, Jessica and Richard are going to cover financial resilience, operational resilience and pricing practices and fair value. We're also going to touch on CAS 14, which we've been getting a number of queries and questions on. I just thought before we dive into the detail, I thought it might be worth mentioning a number of key items that stuck in my mind after having gone through the business plan. I've been reviewing the business plan each year it's been released for the last 10 years or so, and this year it was really noticeable how everything links back to consumer outcomes, or more accurately, poor consumer outcomes. There's loads of examples within the business plan that to me really helped illustrate why topics were included in the business plan and how it all links together. It's not surprising the FCA majored on resilience given the current economic climate, but it is clear that they've set out expectations that firms are going to fail. Paul's going to cover that in detail, but the whole thing seems at odds with the current market conditions, certainly in the broking market, where we've just seen things like the Aston Lark Howdens deal happening. That could be an indicator that the broking market is in rude health, and we might forget that the FCA are really quite anxious about firms failing. They've also stated that consumers, or how consumers have been impacted by Brexit, by COVID. It's not surprising that an additional 3.8 million people now show some signs of vulnerability, and 1 in 6 deferred mortgage payments during the pandemic. Digitisation was also a common thread throughout all the topics. The FCA took both a positive and negative view on this. Clearly there's huge opportunities and upsides in relation to digitisation, but also quite a lot of perils in terms of making it easier for financial crime and again, negative customer outcomes. So there's a real balanced view in there of the ups and downs. And lastly, I guess one of my pet topics is appointed reps, and I think you've all seen that the FCA have announced there will be some kind of consultation on appointed reps. It was probably inevitable from the work that we do on the audit side, and particularly client money. It was always going to happen. My general take on that would be that we're likely to see a more prescriptive oversight regime, but let's see. So I'd recommend you have a read of the business plan, briefly through all the sections. It's absolutely relevant to all of us that work in financial services. That is enough from me. Richard, can I hand over to you to kick us off with pricing practices and fair value?
Thank you very much, John, and good morning to everybody who's online and listening. If we skip on a couple of slides, thank you. We're going to give you an overview today of the general insurance pricing practices and their fair value, and what the FCA had to say about it in its recent publication, the PS 21.5. We skip on a slide, please. So what has the FCA said? From their market research that they did in the survey they conducted in 2020, they've articulated that the home and motor insurance market's not working well for all consumers. They found that 6 million policyholders paid higher than average prices in 2018 than if they'd paid that price through a new business deal, and that would have saved them £1.2 billion. They found that consumers who stay loyal to firms predominantly are being failed by those firms to continue to offer and achieve fair value for those consumers. And they found that markets don't inherently do enough to ensure that they deliver fair value consistently across their distribution chains and to reduce vulnerable consumers to ensure that they are not exploited or targeted with poor value products. We skip on a slide, please. Sorry, and again. The FCA have identified 4 key outcomes from their document, summarised as being pricing remedy, product governance, auto renewal and cancellations, and the reporting requirements coming through onto manufacturers and product distributors. The pricing remedy is designed to reduce and address what is known as price walking in the industry. And this is where the price for renewing customers continues to exceed that of new business written on the same basis of risk and exposure. The FCA have defined a new term in terms of the equivalent new business price, ENBP, and this needs to be calculated for each product and consumer to ensure that renewing business is no longer priced in excess of this ENBP price. Product governance. Under this element, the FCA has enhanced the existing rules to firms and builds upon the value measures established through Prod 4.5. The value assessment that firms need to undertake must consider the reasonably foreseeable period, consider the likelihood that consumers are going to renew, and whether any changes to the product are likely to impact the value received by consumers through that renewal process. The enhancements to the Prod rules, both to manufacturers and distributors, do not change their existing responsibilities, nor do they make manufacturers responsible for the compliance of other authorized firms in the distribution chain. And distributors will still maintain responsibility for complying with the rules set out in Prod 4.3 alongside their ICOB's responsibilities. Under the product governance guidance, all products should now be subjected to an annual review and a product comparison conducted where possible, and assessment of individual target markets. Firms that have not assessed their target markets for product governance will find it very difficult to complete this product governance assessment in line with the requirements set out. Auto-renewing policies and cancellations. Essentially, firms must be able to offer cancellation mechanisms to consumers in the same mechanisms to which the policies were initially incepted. And they should not implement any unreasonable barriers to cancellation, such as elongated caller wait times, or unnecessarily questions, steps, or transfers in process. The act of being able to cancel auto-renewing policies must also be free of charge. So there cannot be any fee charged to cancel an auto-renewal policy once it's incepted. When determining the cancellation methods be provided to consumers, firms must also consider their needs, including those who originally took out the policies, the channels they used, even if those channels are no longer available to new business, and where products are no longer available as new business products. The reporting requirements the FCA have outlined are all about who is responsible for setting the price of the product in the distribution chain, whether that be a manufacturer or whether that be a distributor who ultimately sets the final price, either through gross premium or net premium, or through the use of inducements or fees added or discounts applied to products. If you set the price of a product before it goes to the consumer, you are going to be responsible for making these reporting requirements. And the reporting requirements have been extended to capture net and gross rated business, the tenure of consumers, the distribution channel that's being used, large books of business, closed books of business, core products, add-on products, and fees. For the reporting frequency, the The FCA are looking for a single interim report for the first 6 months from the 1st of January to the 30th of June next year, reportable on the 30th of September next year, followed by annual reporting thereafter. Can we skip on to the implementation and impact, please? Thank you very much. So when does all this come into play? The pricing, remedy and premium financing requirements, this all comes into effect for policies incepting from the 1st of January 2022. There is an allowable transitional period to the 17th of January, provided that the benefits are backdated for consumers, provided that all the information, disclosures and requirements are backdated and fulfilled during that transition period. Premium financing disclosures provide clarity on the premium financing cost and the impact to consumers on contracts where these are being taken up, and the premium finance where they increase the cost of insurance. Zero rated premium finance is not covered in these new rules because it isn't viewed as having a material impact on the cost of the contract. Auto renewal and cancellations, again, policies that are incepting as of the 1st of January next year, these come into force, and firms must implement and make retrospective disclosures on all policies, regardless of if it's in the course of being renewed, regardless of when it does renew. Again, this is a transitional period till the 17th of January, and these disclosures are inlined and covered in more detail in ICOBs 6.26 and 6.51. In terms of the reporting, the first thing is that price setting firms need to understand is that there will be an attestation by a senior manager that the pricing model reflects the ENDP and reflects that renewal pricing is no longer exceeding that of an equivalent new business price. That attestation must be submitted to the FCA by the 31st of March 2022 and will be done on a calendar year thereafter, again being 31st of March. The FCA in their policy statement have provided structured attestation wording for this first attestation and for subsequent attestations that need to be made. It's worthwhile having a read through to make sure you understand the exact wording that they are looking for in this instance. Product governance, we've seen enhancements to CISC, Prod 4.2, Prod 4.5, and these have all come into effect as of the 1st of October 2021. The increase in the rules also bring into scope the pre-October 2018 products that were previously out of scope, and means that all products that are provided for consumer business will, within 12 months of the 1st of October 2021, need to be assessed and need to be subject to a review to ensure that they deliver fair value to clients and consumers and ensure that they are they represent good value, represent fair value to consumers. This impacts the distribution of all non-investment insurance products, including distribution chains through price comparison websites and other intermediaries. It is regardless of the complexity of the distribution model, and includes distributors who are responsible for putting together packages of products, but they must ensure that they do not have a detrimental impact on the value of those products. How is the FCA going to measure success? If you could skip on, please, to two slides. The policy document outlines the FCA's approach to measuring the success of firms. We can turn this into a list of challenges and potential risks to firms who either don't implement or are more sluggish in their approach. In line with the FCA's drive to be a more proactive and data-driven regulator, and linked to the periodic reporting and attestation, firms will likely need to address any existing weaknesses in their data collection, collation and reporting to ensure that value measures, product and pricing data is recorded, analysed and reported effectively. We have seen a recent Dear CEO letter that has already flagged, that already demonstrated that some firms are lagging behind and are unable to demonstrate effective product assessment activities in line with the FCA's expectations. The FCA talks about holding firms to account to ensure pricing remedies continue to work. This and the approach to assign these to a senior management accountable for pricing models points to a more rigorous approach in ensuring price transparency in the renewal process and protection of loyal customers. Firms failing to adopt and implement are likely to be on the receiving end of further FCA focus, potential intervention, and systemic or inherent failings in firms may result in restriction or prohibition of activities. If we can skip on to the assurance, please. And so what does this mean for firms, and what can firms do? Well, firms need to start asking greater questions around these four key aspects. In terms of pricing remedy, you need to make sure, you need to be asking, are our TOBAs up to date to reflect the most recent products that we have, that we distribute, and reflect the most recent FCA guidelines? When we're setting our prices, if we're a price setting entity, or if we're charging fees to clients, are we clear where these are being generated and what they're for? And are we setting them in a robust model? And is there pricing parity at renewal? Are you assessing your business channels, updated placement procedures and disclosures to consumers? Have you assessed any incentives or marketing strategies that you may be looking at for new business and the potential impact that may have on renewing business? Under product governance, we need to be looking at what does your product estate look like, both in terms of any manufacturing, co-manufacturing, or distributing activities you might undertake. Have you identified your target markets, and how have you assessed whether these products that you're distributing or manufacturing provide value, fair value for them? Have you identified the value measures in line with previous FCA guidance? Do you have the data to support the assessment and reporting of those? Have you established an effective product governance framework, especially if you've got multiple distribution routes, multiple distribution channels, and multiple products? Do you have an effective framework to be able to capture all of this and assess it on a regular basis in line with the expectations? And can you conduct effective comparison to closely related products to demonstrate that products distributed or manufactured within your firms do provide fair value to consumers? The auto renewal and cancellation products. Have you identified the cancellation responsibilities and mechanisms that you need to implement for live and run-off products? Even products you no longer distribute, but may still be live, you need to ensure that if they need to be cancelled, that they can be through an effective mechanism. Have you assessed the distribution chain and any reliance that you may place on other players within that chain? And have you established effective data capture of those distribution chains and the policy details to enable your comparison and to ensure that they meet your requirements to be able to cancel? And finally, on the reporting requirements, have you allocated the effective ownership and responsibility for the attestation on price setting? Have you established the relevant attestations in line with the requirements set out in the document by the FCA? Have you updated your systems, reports, and reporting to capture the relevant product details in terms of both fair value and any reporting or comparison that you think you might want to do or that the FCA might want to do? Is the reporting governance effective to deliver on all of these requirements, bearing in mind that we're ramping up a lot more real-time and near real-time information that needs to be captured and reported? Is the reporting sufficiently granular? And is it going to enable you to capture and assess across all aspects that we're looking at? That was a very quick canter through the observations made in the FCA's GI pricing practices paper, and we would welcome any further questions as part of this event. I will now hand over to Jess for her piece on operational resilience. Thank you.
Okay, thank you, Richard. So yeah, as Richard said, we're now going to take a look at operational resilience, and this is by no means a new FCA priority. It's been a topic that has been brewing among the regulators over a number of years. But certainly with the publication of the PRA and the FCA's policy statements and the final rules in March of this year, that's very much sort of drawn a line in the sand following the sort of various discussions and consultations that have preceded them, and really provided some clarity now over the regulator's requirements and the timings of all of that. Next slide, please. So what does the FCA business plan say on this topic? So in many ways, it actually reiterates much of what has been said before, in that operational resilience continues to be a cross-sector priority. This is because of the potential harm that disruptions can cause to consumers and the risks that it poses to market integrity. But it also poses a risk to financial viability and financial stability. And Paul is going to talk in a moment about financial resilience, but there is clearly a close connection between the two. The FCA business plan also sort of briefly reflects on the disruptions caused by COVID, as we would probably expect, and demonstrates how it raises the importance of this topic and the need for firms to be resilient. In terms of the overall outcomes that the FCA is hoping to see, it wants firms to be operationally resilient against multiple forms of disruption and to minimise harm. Interesting, you'll see there in the blue box that the FCA goes on to say that it expects to see a reduction in the number, type and duration of incidents and the harm they cause. I think in my view, the FCA, given what we know about sort of the increasing levels of cyber or ransomware attacks and threats, I think the FCA have potentially set a high bar in expecting the number of events to be reducing. But what I hope is achieved by all of the efforts and the new operational resilience requirements is that firms will be able to manage those incidents better and mitigate any harm that they cause. Next slide, please. So I mentioned at the outset, this is a topic that has been evolving over a number of years now, and I thought it'd be useful to look back at the history and how we've got to this stage. And I thought it would be helpful to firstly reflect on the SSP outage that occurred in 2016, where the pure software platform of SSP was out of action for a number of days or weeks even. But it was very a well publicised event and source of significant disruption among the insurance intermediary sector. It left many brokers unable to operate, as I said, for a few weeks. And it was very much a bit of a wake-up call of the risks that are there from using a third party and the potential impact when things can go wrong. Over the course of 2018 and 2019, both the PRA and the FCA then started to take a more serious look at operational resilience. There's publication of discussion papers and consultation papers, and also an FCA statement talking about the link between outsourcing and operational resilience in January 2020. But then, of course, shortly after that, COVID arrived in March 2020. And did cause widespread disruption, as we all know about too well. I'm not going to dwell on that, but as part of the disruption, it also led to some delay in the regulators finalising their requirements. But the FCA finally then published their policy statement, PS 21.3, in March of this year. And that contains the final rules which aim to help firms to prevent, adapt, respond, recover, and learn from operational disruptions. In terms of the application of that policy statement, it affects a wide range of financial services firms, and insurance intermediaries are covered if they are an enhanced scope SM&CR firm. Other firms are not in scope, but the FCA has said that they may wish to consider the policy framework, and there is always the chance that the FCA may consider including other firms in scope at a later stage. In terms of the timing of this, the new rules come into force in March next year, but there is a bit of a transition period through to March 2025. Next slide, please. So, thought it'd be useful to overview what the policy statement sets out and the requirements, and this slide sets out, provides a sort of very simple overview of the key components of the policy statement and what operational resilience framework is intended to look like. And the starting point for all firms is this identification of important business services. And these are the services that firms provide to clients that potentially cause harm to those clients or risk to the market if they were to be disrupted. So when looking at this, firms really need to think about the services that really do matter to their clients. And for insurance intermediaries, that's likely to include the issuing or renewal of policies or any claims handling services that they provide to clients as an example. Once you've identified those, the next step then is setting impact tolerances for each business service. And these are intended to define the point at which disruption would cause harm and are expected to be set as a duration of time. So for example, 24 hours or 48 hours of disruption being tolerable. But other metrics can also be used, such as the number or the type of customers and clients that might be affected by a disruption event. Once you've done that, you then need to identify and document the various people, processes, technology, and so on that support each of these business services. And this is referred to as a mapping exercise. It's intended to help firms identify where dependencies or vulnerabilities exist. This is potentially going to be a quite complex and time-consuming exercise, but I think it is important that it's done well, as hopefully it will be an important document and tool to help you manage your approach to resilience. Once you've done the mapping, then you need to perform a range of scenario tests. And these are expected to test your resilience levels and your ability to remain within the tolerances that you've set. And the important thing I think to note here is that firms are expected to develop a range of severe but plausible scenarios, and also to develop a plan of regular testing. So it's certainly not something that's expected to be a one-off exercise. After performing those scenario tests, or indeed after an actual disruption event, firms are expected to look at and document the lessons that they've learned from those tests or those events. So for example, if a firm has undertaken a test to see if it could restore data or its systems within a certain time frame of 24 hours or whatever it is, and if a firm was not able to recover within that time frame, they'd need to look at the reasons why, learn lessons from it, implement the measures that they need to take to address it, and of course that acting on the lessons learned is really what the FCA is really going to want to see. The final stage is then about developing a communications plan and how any incidents or disruptions are going to be communicated internally and externally as well. And then the final stage is then about firms having to produce a self-assessment document. And this needs to be quite a comprehensive document that sets out the firm's approach to operational resilience and how it complies with the various components and requirements that we've just covered. Next slide, please. So like any new regulatory requirements, firms are going to have challenges in implementing as well as maintaining this in a business as usual environment. In terms of implementation, I think there are a number of challenges there, and I've heard various debates about what constitutes an important business service or how granular the mapping exercise needs to be. But I think taking a step back from some of that, I think it's important to highlight that it's important that the board is supportive and actively engaged in implementing all of this. Ultimately, your firm's board is going to be expected to sign off on the important business services that you've selected, the tolerances that you set, the mapping, the self-assessment document, and all of this. So they really do need to be engaged at the outset and throughout the process. Secondly, it's really important to emphasise that implementation of all of this isn't something that can be left with your compliance or your IT teams. Firms are going to need to involve a wide range of internal stakeholders to help them to identify the people, the processes, the systems that support the important business services that they've identified. So it very much needs to be a cross-firm effort. You're probably going to need to get a better understanding of your outsourcers and third parties that you use, particularly the vulnerabilities that might exist within there, and the resilience arrangements that those outsourcers and third parties have in place. You're going to need to engage with them, and you may have some challenges or pushback in getting the information or the assurances that you need. Finally, then, on implementation, I would also warn and encourage you to be careful not to over-engineer all of this. I think when new regulatory requirements come out, there are often two camps. There are those that do nothing or do little, or there are those that sort of throw the kitchen sink at it. But the FCA are very clear that operational resilience frameworks need to be proportionate to a firm's business. And I think, for example, that there is a real risk that firms could potentially produce very complex mapping documents that are really not going to be very user-friendly or may quickly become redundant and out of date. In terms of business as usual side, there are a number of things there on the slide for you to think about. I think it's important to note that the FCA does expect firms to review their operational resilience frameworks at least every year, or when there are material changes. And certainly given the rapid pace of change and growth within the insurance intermediary sector, this could potentially be quite challenging for those firms that are subject to those significant changes. As firms move into business as usual, I think they also need to think about the assurance needs that they're going to require in this area. To date, PKF's internal audit clients are still working on establishing their frameworks, but as they become live and implemented next year, we're expecting to see a need and an increased demand for internal audit to be looking at the adequacy of those frameworks and whether they align both to regulatory requirements, but also to business needs for being resilient. Although there are a number of challenges there, I think it's helpful to note that the FCA does refer to this concept of firms being on a resilience journey. And framework is the recognition that frameworks will very much evolve and refine over time. Next slide, please. So as we close on this part of the presentation, I thought it might be helpful to share some of PKF's observations from the various internal audit work that we've performed in recent times and that are relevant to this topic. Firstly, point I wanted to make there is that we are seeing a lot of firms taking great comfort from the fact that they've remained operational during COVID-19. And when we ask our clients whether they have sort of tested their recovery plans in recent times, they often say, yes, we have, because the pandemic has tested our recovery and ability to operate. And not wanting to sort of take anything away from that, and it's obviously really positive that firms have managed to continue throughout the disruption. It's also important to recognise that COVID is only one form of disruption, being the loss of your offices or potentially some disruption to your people due to illness and so on. But the pandemic hasn't actually tested your firm's resilience to other scenarios, whether it's sort of loss of power, loss of data, loss of a particular system, or failure of an outsourcer. So it is important that you consider the full range of scenarios and actually test against them. Linking to the point I said earlier, then we do often see a lot of reliance being placed on IT teams for being responsible for resilience and recovery. Although IT systems are a significant part of your operations, you can't delegate the whole responsibility for this to your IT team. And it's very much about ensuring there's that board ownership and involvement of a wide range of parties within your firm. We're certainly seeing increasing use and reliance on outsourcers and third parties, particularly cloud providers. Our IT assurance team has been looking at this and the control frameworks around these sort of cloud arrangements. And often in these instances, seeing quite a lot of reliance being placed on those cloud providers and their recovery arrangements. But firms do need to have a look at this and take a bit more ownership and make sure, for example, that they do have a copy of their own data, so that in the event that there is downtime or data issues within the cloud, firms do have the ability to recover what they need. Day-to-day oversight of outsourcers and third parties is also often lacking. I'm not going to go into detail on that, but I wrote an article a few months back on outsourcing risks and the FCA expectations for effective oversight, which I'd recommend you go and have a look at. And then finally, COVID has highlighted the importance of people and people risks. If individual teams or individuals or teams are not available. And when we've been looking at firms' succession plans, often as part of our governance reviews, we look at these. And these are key to managing some of these people risks, and they're often not complete or not well developed or simply out of date. And it is an area that needs a bit more attention. So finally, just as I want to close then, my sort of final comment here is, while the FCA and the regulators are focusing on operational resilience, this isn't just a regulatory issue. And I think we're expecting to see and starting to see already that wider stakeholders are taking an interest in firms' resilience. I think in particular for many of you in the room, you may be cover holders of Lloyd's syndicates, and insurers are going to be looking closely at their own resilience arrangements and are likely to be asking questions of you about your resilience and the arrangements that you have. So this is very much going to be a topic that affects across the market and one that everyone needs, including sort of core and enhanced firms, one that everyone is going to need to get on top of and take seriously as an important topic. I'm now going to hand over to Paul, who's going to touch on financial resilience.
Thank you, Jess. And good morning, everybody. First slide, please. The FCA have stated in their 21-22 business plan that the whole issue of financial resilience and resolution is one of their overarching priorities across all the various financial services sectors. The FCA recognises that firms with weak financial resilience will fail, and the focus of their recent sort of prudential regulation is to ensure that they do so in an orderly manner, again with the same theme, without causing harm to consumers, markets, or the wider economy. The FCA views solo regulated firms, that's firms that are only regulated by the FCA, as not actually being individually systemic. Therefore, they feel that the effects of failure can actually be contained. And as a result, in this business plan, the FCA is targeting various outcomes and actions to ensure that failure is contained and not deemed to be contagious. Next slide, please. I want to look especially at how financial resilience has affected and is affecting insurance intermediary firms. It's clear to say that COVID has had a mixed impact on firms, depending primarily on sector exposure. Most sectors have held up quite well, but there are some, such as travel, hospitality, which have been, completely ravaged. It's fair to say that last year, 2020, was a year of general survival for most firms. They were protected by the hardening rates in the market. The working from home protocols saved them an awful lot of money. They had the furlough scheme to be able to use. And there was a whole variety of government props such as CBILS bounce back loans, tax deferral schemes, etc., which all help them to survive in what were sort of difficult conditions. However, 2021 is also proving to be a year of possibly even more challenge. We're experiencing a little bit of a stuttering economic rebound caused through the inflationary sort of issues and the supply chain issues. We've seen the end of the furlough. We've seen the need to now to start repaying the various sort of C-bills, bounce back loans, etc. And we're now having to start to pay that tax that we had originally deferred. So it's clear, and certainly from my sort of, looking at the various sort of smaller firms that we deal with, that there are a lot of firms that are actually struggling. Next slide, please. So throughout this period, the FCA has actually been engaging with the insurance markets since the start of lockdown through their COVID-19 impact surveys. And for some firms, they continue to do so, gathering intelligence on the effect of COVID-19 on individual businesses. The results of the survey were initially published earlier this year on the 7th of January. There were 3,370 insurance intermediary responses out of 17,115 across 7 financial services sectors. In terms of the GI firms, the key results were as follows. Generally, the available cash exceeded their cash requirements, but on average by about 3%. So there wasn't much of a buffer there. Only 14% of GI firms had actually negotiated extensions with their creditors or tried to have a sort of late payment type arrangement. 60% of insurance intermediaries were expecting for there to be a negative impact on their income going forward, but most of those were within the lower range, between 1 to 25% in terms of a drop of income looking forward. 44% of insurance intermediaries had used the furlough scheme, but only 19% of insurance intermediaries had actually received a government loan. Next slide, please. So what are the key messages that the FCA are really trying to sort of get to the market based on this intelligence? They're recognizing the fact that although economic activity is improving in 2021, the regulator is still expecting some firms to fail, and this is supported by the results of their COVID impact survey. So the key messages are, we expect you to be under financial stress. We expect you to have sufficient capital to get through this. We need you to figure out how much capital you need versus how much you have, using a sensible, calculated approach, not just hoping for the best. We expect you to tell us, i.e. communicate with the FCA, if you do not have the capital. And if you don't have the capital, you need to figure out how you're going to shut down your operations in an orderly manner, again, without causing harm to clients or the market via a well-constructed wind-down plan. So again, that theme of trying to protect consumers. And above all, the key message here, and clearly the FCA's sort of main concern, is that if you do hold client money, they do not want you to use client money to fund your business. That's a very, very clear message they're sending out. Next slide, please. So again, the FCA's overriding concern in all of this is clearly the protection of client money for those firms that hold client money. The FCA initially reminded firms, firstly last year on the 30th of September 2020, and more recently on the 2nd of July, of the need to continue to protect client money through ensuring compliance with CAS 5 across all main areas. We saw that in the letter that they sent out in July of this year, there'd been a real ramp up in the tone of the letter. The original letter of the 30th of September was more of a reminder of the need to comply with CAS 5. This latest letter talked about the possibility of fines, prohibitions, enforcement action, and it was very clear that the tone was far more serious than the first letter and that they really meant business. The letter required boards of directors to carry out a self-assessment of their compliance against the CAS 5 rules. And the FCA did say in the letter that they would be expecting to see evidence of this when they visited firms. The FCA also said that they expect to continue talking to firms on client money, and in some cases where they're concerned about client money, they will increase their intervention. The FCA is expecting firms to review and examine the client money audit reports that we produce and to attempt to demonstrate continual improvement with the CAS rules. So in our client money reports, we will normally have a breaches schedule. They will expect boards to have responded favorably to those breaches, have actually set out what remediation actions they're going to take to improve those breaches. And they're going to want to see a general direction of travel whereby, you know, the breaches have been remediated and the firm is becoming more and more compliant with CAS 5. The firm is very nervous of those firms who receive clean reports, particularly from less experienced audit firms. We must audit in excess of 100 firms for client money. I would have thought that the number of clean audit reports that we give is less than 5%. There are some firms that get clean audit reports, but when you combine the clean audit report with perhaps the name of a lesser known, lesser experienced audit firm, that makes the FCA very nervous. And the FCA reminded firms in that letter that it's their own responsibility to do due diligence on audit firms and to appoint a competent audit firm as regards their knowledge of the CAS rules. It's not enough to just say to the FCA, well, you know, the auditors gave us a clean audit report. You have to make sure that the auditor knows what he's doing and appoint the relevant sort of audit firm that can give you that sort of comfort. And finally, in that letter, the FCA also reminded firms of their responsibilities under sub 15.3 and principle 11 about being open and honest in their communications with the regulator. Next slide, please. So what are these desired outcomes that the FCA wants to achieve in terms of financial resilience? They want firms, they say that firms need to have appropriate capital, appropriate liquidity, and appropriate reserves to cover all outstanding liabilities in case of failure. They want firms to hold financial resources which are proportionate to the potential for harm that they could cause if they fail. And they want firms to hold more capital, more liquidity to ensure that in the medium to longer term, compensation liabilities are stabilized. So really, they don't want to have more and more repeat cases of us having to resort to the financial services compensation scheme. So what does this mean in practice? It means that firms need to plan ahead to ensure sound management of financial resources through detailed budgeting, detailed stress testing of those budgets, and not sort of adopt what we often see, which is just a wait and see what happens type of approach. They want firms to assess their capital requirements as against their capital availability through detailed capital resource requirement monitoring, again with appropriate stress testing against various sort of doomsday type scenarios, and to ensure that they've built in adequate buffers to be able to sort of deal with any of these eventualities. They also introduce the whole concept of conservation of capital. They feel that firms need to look ahead, need to see what the potential demands on their liquidity are, and need to ensure that they have conserved sufficient capital to be able to sort of afford any surprises in the future. And they effectively want there to be sort of more reasonable and more sensible decision-making around discretionary spend, around things such as the payment of dividends, the payment of discretionary bonus payments, or any other discretionary spend, things such as share buybacks. They want to ensure that these are done in a prudent and consistent manner in accordance with their risk appetite. They wouldn't be very impressed, for example, if you knew that you were going to be loss-making in the future, yet you suddenly paid a very big dividend and effectively wiped out your reserves that could have been used to mop up a loss in the future. So they're very much asking management to sort of look ahead and be sensible in the way that they're sort of, you know, budgeting for their capital and their liquidity going forward. And effectively, they say that if you do have insufficient capital, you need to engage early with the FCA to plan to exit the market in an orderly manner. Again, same theme of avoiding harm to customers via a well-constructed wind-down plan. Next slide, please. In terms of the actions that the FCA are proposing to be able to sort of achieve these outcomes, there's a variety of things which are quite interesting in terms of the business plan. They're looking to strengthen the data-driven monitoring of financial resilience of FCA-only regulated firms. It's unclear on how this is going to work for GI firms, but for example, for investment firms, they've already mentioned that they're going to be introducing a new investment firms prudential regime. So this might be a sign of things to come, a whole new sort of revamp of the prudential rules with the view to holding more capital in the future. They're looking at targeting more direct intervention at those firms who they perceive to have weak financial resilience. They're also looking to automate and combine financial resilience data with other data that they hold on firms to really try and get at the root cause of financial risk management weakness. And more recently, they issued the wind down plan guidance. That was in April of this year, with the requirement for all regulated firms to put in place a wind down plan to demonstrate how they would exit the market in an orderly manner, again, without causing harm to consumers, markets, or the economy at large, and at the same time having regard to its financial and non-financial resources to be able to do so. Next slide, please. We've been doing a bit of work recently in helping a few firms put together their wind down plans. And I thought I would sort of share with you some of the observations that we've taken down based on the work that we've done, what we've seen, how that relates back to the wind down plan guidance, and just some sort of practical points that might be helpful. So just to start off with, the wind down plan guidance applies to all regulated firms. There's a common misnomer out there that you only need to do this if you're in financial distress. That's not the case. The FCA are saying that things can happen overnight, as the pandemic proved, that everybody needs to have a wind down plan in place to be able to demonstrate that they can exit the markets in an orderly manner. Because this is relatively new guidance, there is no set pro forma or template. There's nothing out there to say this is what it needs to look like. It just needs to be prepared dependent on the firm's own circumstances. And the objective really of the wind down plan is to have a plan in place to reduce the risk of there being a detrimental effect on consumers and markets when the firm winds down its business. Having said that there isn't an actual template or pro forma, most wind down plans tend to have more or less the same sort of similar components. There's normally an evaluation of the scenarios that could lead to the firm no longer being viable. So these are known as the trigger events. And normally what would happen is that there would be a modeling of what would happen if these various sort of trigger events took place. Sometimes trigger events occur in combination. Sometimes they might just be one event. For example, a failure to meet your debt covenants on some debt financing, which then means that the debt funds that are causing your loan and you therefore have to wind down. So the first stage is always the evaluation of the trigger event. You then need to sort of put a plan in place to document and articulate how you're going to steer the firm in an orderly manner. There is then an assessment of the financial and non-financial resources required to support the orderly wind down. And finally, there is the processes in place for proactively identifying and mitigating any material risks or obstacles to prevent you from winding down in an orderly manner. So what does this look like in practice? So what we've seen is that there's really sort of two parts to this. Most wind down plans will firstly consist of a set of financial projections, which go to the end of the identified wind down period, supported by some detailed assumptions, normally identifying the TC 2.4 buffer required to wind down and effectively ensuring that you've got the adequate financial resources to be able to do so. So really identifying how much money you're going to need to implement this wind down plan, and effectively to be able to then, as a healthy firm, ring fence this amount as effectively your TC 2.4 buffer. And the second element of the plan that we're seeing is a detailed narrative plan setting out how the orderly wind down plan will be carried out in practice, addressing all financial and non-financial risks, looking at things such as, what sort of level of staff do you need, what sort of level of infrastructure you need still to sort of be operating, how are you going to ensure that you're going to retain that staff, how are you going to ensure that you've still got, your operational licenses and all your various sort of infrastructure, etc., etc. One of the things that we've seen from the firms that we are helping at the moment is that they're very strong on preparing the financial projections, a very detailed model. There's very little in the way of detailed narrative. And the FCA guidance is very clear that it's not sufficient just to have lots of numbers. There has to be a clear plan that somebody can follow so that you can see exactly how you're going to be dealing with the operational logistics of the actual sort of wind down plan. And the other thing that we're seeing a lot is that there needs to be buy-in and approval from the firm's governing body. This isn't just an exercise that you ask the finance department to do. This has to have approval from the firm's board of directors right from the off, and will be finally signed off by the board of directors. And again, we're seeing at the moment with the various sort of exercises that we've done that it's been effectively delegated to the finance department. The board will sign off at the end, but there hasn't really been that much discussion by the board on how the wind down plan will actually take place. They've just accepted really whatever the finance department have given them. And at the end of the day, the end results following the wind down will be the cancellation of the firm's Part 4A permissions. And again, the FCA have said very clearly in their guidance that they have no intention of cancelling permissions unless they are completely satisfied that the firm has wound down in an orderly manner. So that's all I wanted to say on financial resilience. I'll be around at the end to take questions. I'm sure you've got lots. If we could now move on to the next part of my presentation, please, which is CAS 14. This isn't actually anything which is part of the FCA business plan. We thought we would have a little session at the end on CAS 14 because it's relatively new. It won't apply to everybody in the audience, but it might apply to some of you. And in fact, I know that it does apply to some of you. But we've had a lot of questions really because we feel this is an area that hasn't really been introduced that clearly by the FCA and has led to more questions and answers. First slide, please. So CAS 14 effectively deals with client money rules for firms which are operating under the temporary permission regime. So to give you some background, most EEA firms wanting to have businesses in the UK have had to obtain temporary permissions under the TPR to continue their activities in the UK for a limited period post-Brexit. The FCA is now starting to award what they call landing slots to these firms and allowing them a slot to make an application for them to apply to become fully authorized and obtain their Part 4 permission. And previously, all aspects of client asset protection for incoming EEA firms was regulated exclusively by the home state regulator. There are some jurisdictions in Europe which are quite strong on client money. There are others that hardly recognize it at all. So it's a real mixed bag. What the FCA did was that they introduced CAS 14, and CAS 14 actually sets out the rules that the FCA will apply to TP firms that receive or hold client assets in respect of their UK businesses. Next slide, please. One of the reasons that I chose to sort of talk about this is that there's been a fair bit of FCA engagement, really. A lot of firms who have set up European intermediaries and then branched back to the UK have received a whole variety of sort of surveys and communications from the FCA recently. And there's been a bit of confusion as to how they should be answering these surveys. The first communication was back in May 21. where effectively they asked firms to sign an attestation where firms had stated in their original application, TP application, that they intended to safeguard client money, custody assets for UK clients. This was followed up with another survey in August, where the FCA again asked for a further attestation for firms to basically attest that they understood their obligations under CAS 14. And there's been a bit of confusion as to what this really means. And what this really means is that this really only applies to those EEA firms that are actually insuring UK in situ risks, as all other non-UK risks will be under the jurisdiction of the home state regulator. And the FCA also in the survey asked the firms to effectively categorize themselves in accordance with a CAS classification per the definitions in CAS 14.2. And effectively what this basically means is that you need to calculate the amount of client money that you feel that you're going to be holding, the largest balance that you're going to be holding in the TP's last calendar year. And if it's more than 1 billion, you become known as a CAS large TP firm. If it's between 1 million and 1 billion, you will be a CAS medium TP firm. If it's less than 1 million, you will be a CAS TP small firm. And effectively, you then need to, if you are caught within these rules, the FCA requires the relevant TP firms to prepare and submit what's known as a TP CAR, which is a temporary permission client assets return in relation to those UK risks that the EEA firm is effectively writing in the UK. Next slide, please. And the rules effectively under the TP CAR reporting regime follow very similar rules to the RMAR reporting that you'll all be familiar with as regards frequency of reporting and also as regards the sort of time deadlines for submission. So for example, where a firm deems that they're going to have relevant income, i.e. in respect of UK risks, which are in excess of 5 million per year, they will be requiring to submit this TP CAR form on a quarterly basis, as you would do for an RMAR. The only difference being that if you are a small or medium firm, you only have to report once a year rather than sort of twice a year, as with the RMAR. In terms of the client asset reports, this is only in scope if you are a firm that's subject to MiFID II, therefore an investment firm. And if you are an investment firm, an English translation of a client assets audit report must be sent to the FCA following the same sort of reporting rules that we have with client money, either on request by the FCA or if an adverse opinion is given. So essentially, I suppose the message here is that if your branch is not ensuring any UK-based risks and you're therefore a non-MiFID II firm, then there will be you won't have to prepare a UK client money audit, as effectively this will be covered under the rules of the relevant home state regulator. So that's all from me. I'm now going to hand back to John for a quick summing up and then on to Q&A. Thank you very much.
Paul, thanks so much for that. I think it's, particularly on the CAS 14 area, there's a limited number of firms that applies to. I'm sure Paul will answer any questions on that. We hope you found the webinar version of our session helpful. Please feel free to reach out to any of the participants on our end. We'd be delighted to hear from you. Thank you for joining us.
That was great. Thanks, guys. I will I'll cut this in our editing thing, so it'll stop after John's spoken. Well done. It's really good.
Cool. We need to knock about half an hour off it for tomorrow.
I was going to say we started at just before 5:15. So it's just over an hour.
Okay. Yeah. Okay. So
maybe
we're aiming for 45 minutes, are we, tomorrow?
yeah, if you want to leave time for questions, that'd be great.
Yeah.
Okay.
Did you note down the relative times, Jenna?
No, I looked at just it. I can go back and look though. I'm happy to do
Yeah,
that.
I guess we've got a recording, haven't we?
Yeah.
I think
Yeah.
the timings we planned for were about 50 minutes and then 10
Yeah.
minutes for questions.